Hey everyone, welcome back. Ready for another deep dive.
Always.
Today we're tackling a topic that's, well, kind of central to investing, wouldn't you say?
Pretty much, yeah.
We're talking market cycles, folks. Those ups and downs that, let's be honest, can make or break your portfolio.
They can be pretty wild, that's for sure.
And to guide us through this complex landscape, we've got Howard Marks' book, Mastering the Market Cycle.
You picked a good one. This
Yeah.
book is like the Bible for understanding this stuff.
Right, it's packed with insights, but one thing that really struck me was this idea that even things that seem totally unrelated to the market, like politics,
Oh, yeah.
can actually play a role in these cycles.
Absolutely. I mean, everything's connected.
So before we get too deep, maybe we should just start with the basics. Why is understanding these cycles so important in the first place? What's the big deal?
Well, if you think about it, markets don't just move in a straight line, right? They go up, they go down, and sometimes they stay flat for a while. It's like
Yeah.
a roller coaster.
A very expensive roller coaster sometimes.
Yeah, that's a good way to put it. And the thing is, these ups and downs aren't random.
They're not.
Nope. They actually follow these like predictable patterns. I mean, not predictable in the sense that we know exactly when they're going to happen,
Right. Yeah.
but predictable in the sense that we can understand the forces that drive them.
I see. Okay. So by understanding these forces, we can maybe, like, anticipate what might be coming next. Right?
Yeah. Well, more like anticipate the possibilities, you
Mm.
know? We can kind of get a sense of where we are in the cycle and make smarter decisions based on that.
Okay, so let's dig into that a bit more. What are these forces that are shaping these market cycles?
Well, Marx breaks it down into two main categories: human psychology and economic fundamentals.
Those seem pretty broad.
Yeah, they are.
Yeah.
But stick with me here. Let's start with the psychology piece.
Okay, right.
So think about it. When things are going great in the market, everyone's feeling confident, right?
Everyone wants a piece of the action.
Exactly. And that can lead to like this irrational exuberance.
Oh yeah, people get a little carried away.
Totally. They start bidding up prices, sometimes way beyond what's justified by the actual value of the assets.
Like they're not even thinking straight.
Right. They're just caught up in the hype. And that, my friend, is how bubbles form.
Those dreaded bubbles.
Yeah. But on the flip side, when things start to go south,
People panic.
exactly, fear takes over, and everyone starts selling, driving prices down even further. It's like a self-fulfilling prophecy.
And this whole cycle, it's driven by our emotions.
A big part of it, yeah. Marx argues that understanding these emotional swings is crucial to navigating the markets effectively.
So it's almost like we need to be like emotional detectives, figuring out what's driving the market's mood.
Something like that.
So that's the psychology piece, but you mentioned economic fundamentals too.
Yeah, so these are things like interest rates, inflation, government policies, all those fun things economists love to talk about.
Yeah, the nitty-gritty stuff.
Right. And these factors play a huge role in shaping the overall economic environment, which in turn influences market cycles.
It all makes sense now.
For example, when interest rates are low, borrowing money is cheap, which can fuel economic growth and lead to higher asset prices.
I see. But if interest rates start to climb,
Well, then things can start to cool down. Borrowing gets more expensive, businesses might invest less, and that can put downward pressure on the market.
so these economic fundamentals are like the foundation, and then our emotions kind of build on top of that, right?
That's a great way to put it.
Okay, so we've got these psychological and economic forces at play, but how does this all tie back to making smarter investment decisions?
That's where things get really interesting.
I'm all ears.
Marx argues that understanding where we are in a given cycle can help us identify potential opportunities and risks.
Okay, can you give me an example?
Sure. Think back to the dot-com bubble in the late 90s. Everyone was pouring money into internet stocks, but many of these companies had no real earnings, no proven business models.
Yeah, it's pure speculation.
Exactly. And because investors were so focused on the potential, they ignored the fundamentals, driving prices up to unsustainable levels.
And we all know how that ended.
Crash. But if you had understood that the market was in a bubble phase, driven by excessive optimism and speculation, you might have been more cautious.
So you're saying recognizing those patterns, those signs of irrational behavior, can help us avoid those big losses.
Exactly. It's all about managing risk.
Makes sense. But it's not just about avoiding the downside, right?
Nope. It's also about recognizing opportunities when they arise. Marx argues that when fear dominates the market, when everyone is selling, that's often the best time to buy.
That's when you can find those hidden gems, those undervalued assets.
You got it. And that's where that famous Warren Buffett quote comes in. Be fearful when others are greedy, and greedy when others are fearful.
Ah, yes, the sage advice of the Oracle of Omaha. But okay, this all sounds great in theory, but doesn't this mean we have to, like, try to time the market perfectly?
Not at all. In fact, Marx explicitly says that trying to time the market, like calling the exact top or bottom, is pretty much impossible.
Ooh, okay, that's a relief, because that sounds stressful.
Yeah, no kidding. What he advocates for is a more like strategic approach. It's about recognizing where we are in the cycle and adjusting your risk exposure accordingly.
Okay, so, like, if we think the market's getting a little too hot, we might shift towards more conservative investments, right?
Exactly. You might reduce your exposure to stocks or real estate and increase your holdings in things like bonds or cash, which are generally considered safer.
Got it. So it's more about tilting the portfolio, not making these huge all-or-nothing bets.
Right. It's all about finding that balance, managing risk, and staying disciplined.
So this whole idea of cycles, it's not just about the stock market, right? Marx talks about cycles in all sorts of different markets.
Oh, yeah, he covers a lot of ground. He talks about real estate cycles, commodity cycles, credit cycles, even the cycle of political elections.
That's right. I'd almost forgotten about that part. It's amazing how these patterns play out in so many different areas of life.
Yeah, it's pretty fascinating. And understanding these cycles can be incredibly valuable for investors, entrepreneurs, even just for making informed decisions in your everyday life.
For example, if you're thinking about buying a house,
It would be helpful to understand where we are in the real estate cycle in your area. Are prices peaking? Are they starting to decline? Knowing this information can help you make a smarter decision about when to buy and how much to pay.
and the same logic could apply to other things like starting a business, right?
Totally. Let's say you're thinking about opening a restaurant. Well, understanding the economic cycle could be really helpful in terms of predicting demand, managing costs, and making sure you're not launching right before a recession hits.
I never thought of it that way. So whether you're an experienced investor or just starting out, this whole concept of cycles, it's something that everyone can benefit from understanding.
Absolutely. And that's why Mastering the Market Cycle is such a valuable book. It gives you a framework for thinking about how markets work, for recognizing those recurring patterns, and for making decisions that align with those patterns.
It's not about predicting the future.
Right. It's more about understanding the forces at play and making informed decisions based on that understanding.
And that's a skill that can pay dividends in all areas of life, not just investing.
Couldn't agree more.
So, as we wrap up this deep dive, here's a final thought for you all to ponder. Think about an area of your life where you're making decisions that involve some level of risk, whether it's your career, your finances, or even your personal relationships. Are there any signs that you might be overlooking? Any patterns that could help you make better choices? Food for thought, folks.
Great one.
Thanks for joining us on this journey through the fascinating world of market cycles. Until next time, happy investing.
See ya.